Okay. Hello, everyone. I hope you can hear me and you can see me. My name is Sergey Yashka. I'm going to moderate today's event, and we will also have some other events tomorrow and the day after tomorrow, and I'm going to moderate them as well. First of all, thank you very much for coming today and participated in this event, and thank you to David Berger, our lecturer today, professor from Duke University, who agreed to join us and to give a talk. So what is going on here today and in the future day? The National Bank of Ukraine every year organizes annual research conference on monetary policy and related topics. And every year we have a number of star panelists and speakers. And together with this annual research conference, we organize a number of online lectures for students. So that's why we are all here today. This year, in this online lectorium, 76 of universities from 25 cities in Ukraine registered to participate. And right now we have more than 200 attendees. So thank you very much everyone for coming, and this number continues to increase. So what do you get? Some pleasant bonuses for everyone who attends these online lectures. Participants who attend all 3 online lectures will get certificate of attendance. Then you will be able to ask questions as well during the lectures, in the end of the lectures. And the authors of 3 the most interesting questions will get some some good prizes from the National Bank of Ukraine. One more thing is that we encourage you to share your experience, share your feelings, share your feedback on Facebook using hashtag NBU Lectorium 2020. You will see it on the screen soon. And the authors of the 5 the most popular posts will get some prizes from the National Bank of Ukraine as well. Before we start, just a couple of rules, how it will go. Most of you are attendees, and for you, you will be muted and your camera will be off during the whole event. However, you will be able to write question in English or Ukrainian. We will translate it for you in the Q&A section. You can find Q&A button in the bottom of the screen. And if we choose to answer it, everyone will see this question. So the questions will be in the end of the day. I will introduce David Berger. Then we will have approximately 40 minutes for the lecture and maybe 15 minutes for questions in the end of the day. Okay, so going to today's lecture, we are very happy to have David Berger from Duke University in the United States. And he will present the results of his research on monetary policy issues. And the topic of his online lecture is how monetary policy works in practice for households. David, thank you so much for joining us. You can unmute yourself, you can share your screen, and the floor is yours. Thank you.
All right, well, thank you so much for coming. I will try to make this as enjoyable and interesting as possible. Let me share my screen. I hope everyone can see this. So I'm just going to start. So the title of this lecture is How Monetary Policy Works for Households. So just as a bit of a background, I've done a lot of work on how monetary policy transmits to households. And, you know, typically when I used to teach intro macros, so a class of 300 people. And the way we talk about it is, you know, the central bank has this trade-off between inflation and output. They care about both objectives. And then what happens when we get into a recession, if there's a negative demand shock, you know, we hear the same story. It's always, what is the central bank supposed to do? Well, they're supposed to sort of give money to banks by purchasing some sort of like government securities. The banks take those additional money. What do they do with it? They lend it out. That's what we call the money multiplier. That shifts the market for loanable funds out to the right, and that tends to lower interest rates. And that lower interest rates makes it cheaper for both households and firms to borrow and to go spend. So investment should go up and output should go, or consumption should go up. So that's what we're taught. That's what I teach all of my students. And for firms, this is a pretty accurate story. I think roughly speaking, it's kind of true. If you make it cheaper to borrow, more firms are going to borrow. But the question is today is like, does it really work that way for your household? In particular, think about your mom or your dad. Does your mom really, if interest rates are lower, do they even know that? And if they are lower, do they change any of their behavior? So that's what we want to think about. So why would changing the interest rate, I think it's important to think about this, affect how much you want to spend, particularly when we're talking about something like 25 basis points, like 0.25 percentage points, something very small. I think it's pretty unlikely. So what's the theory? The theory is based on opportunity costs. So obviously, what is the interest rate? It's just the relative rate of return between today and tomorrow. So if you lower interest rates, the opportunity cost of saving more today is now lower, which means you should spend more today. That's it. Basically, the interest rate means you should spend more today. And in our models, if you write down a complicated model, I don't know how advanced y'all are, but that works. But it relies on sort of like two crucial assumptions about humanity. The first is that they're very forward-looking, that they can look many far in the future and they're very rational. The second is that they're not borrowing constrained, meaning they have enough money to take advantage of stuff that might happen many far in the future. So I know less about the financial balance sheets of people in Ukraine, but in the United States, people do not have enough money. Only 40% of households can cover, a moderately unexpected expenditure. Okay, so I want to think about, well, it still seems, so maybe you don't believe that people are super forward-looking or are not borrowing constrained. So, and in practice, that seems to be true in the US. So how could monetary policy be working if the traditional channel isn't going to work? So today, I want to think about that. And so here, I'm going to talk about how, at least in the US and in Western Europe, it seems to work through the housing market, and in particular through household borrowing, which is through a mortgage. So before I go into that, let me talk a little bit about some definitions, so we just are all on the same page. Okay, say you buy a house. So I recently bought a house, and say it's $100,000, so a moderately expensive house, and you pay with what's called a 10% down payment. So what does that mean? That means the value of the house, the asset value of the house is what? It's $100,000. What is the equity? That's how much money, how much do you own in the house? Well, you put a 10% down payment down, which means you put up 10% of the money. So 10% of 100,000 is $10,000. And then what about the rest? You had to borrow it. And that borrowing is called a mortgage. So how much did you have to borrow? You had to borrow $90,000, 100,000 minus $10,000. So some terms in this literature, a key one that we're going to see over and over again is called the loan to value ratio. What is that? That's the amount you borrowed, that's the amount of your mortgage, divided by how much your home is worth. So in this case, we borrowed $90,000 to buy a $100,000 home. So that's 90 over 100 is 0.9. So obviously, as you see, the closer the LTV, the higher LTV means you're borrowing more money. If you had an LTV of 0.5, that would mean you only borrowed 50% of the value of the house to purchase it. So a higher LTV means people are borrowing more. And that's why you'll hear this phrase that people are more levered, meaning they have higher LTVs. Now, you may ask, now what about in America? What kind of LTVs do people typically have when they buy a home? So I plotted that in the bottom down here for two government programs. The red one is like for people who are older, more mature, have very good credit. That's called a GSE mortgage. You don't need to know that. Well, you can see it's around 80, which means their loan to value ratio is 0.8. So mostly people are borrowing 20%, 80% of the money, and they're putting up 20% of their own in a down payment. Now, many people don't have that much money up front. Like, for example, it's hard to come up with $20,000 in cash for the down payment. So there's other programs in the blue which help first-time home buyers, people the first time they buy a house. There, you can only put up 3.5%. That's why there's a spike at 96.5, 100 minus 3.5. So what does this tell you? This tells you that to buy homes in America, people typically borrow a lot of money. They have high LTVs. So some more background. Roughly speaking, 65% of Americans are homeowners. The home ownership rate varies a lot. In Italy, it's 80%. In Germany, it's closer to 50%. And typically, it depends on the strength of the mortgage market. So broadly speaking, there are two types of mortgage products that you need to know about. The first one is called a fixed rate mortgage, or an FRM. So what does that mean? That means when you borrow, you get this mortgage, you borrow, say, X dollars, you borrow it for T periods, say 30 years, 15 years, and the interest rate you borrow from is fixed. That's why it's a fixed rate mortgage. So the idea would be I borrowed $100,000 for 30 years at a 5% interest rate. And that interest rate is constant for the whole 30 years. So in the US, this is the dominant mortgage contract. It's also the dominant mortgage contract in Denmark, but in other countries, a more typical framework is called an adjustable rate mortgage, an ARM. What is that? Well, it's the same kind of idea. You borrow X dollars for T periods, but now the interest rate varies over time with the market. So here would be I borrow $100,000 for 20 years, but the interest rate can vary. So the main difference between these two products is that the interest rate is either fixed or varying. That's why it's in a fixed rate or an adjustable rate. And there's some hybrids where it'll be fixed for a little bit and then switch. Those are also called things. Those are called option arms. But anyway, the key thing I want you to think about is the higher the interest rate, the higher the monthly payment, the more expensive it is to be in the house. Obviously, if you buy a house, you would want to pay because you're borrowing the money, you want to pay the lowest amount of money possible. So you want the cheapest interest rate. So typically what you should see is that when interest rates fall, many people want to get new mortgages. Many people want to have the cheapest loan possible. And when interest rates rise, many people are not going to buy homes because now it's quite expensive to get a mortgage. Because if you get an interest rate when it's 10%, that's a much higher monthly payment than if you got an interest rate if it was 2%. So now let's think a bit about, let's go back to our motivating question, which is what happens to, like, how is it going to be that Fed policy lowering the federal funds rate is going to translate into mortgage rates? So let's assume that that does. So the Fed, let's say the Fed can control interest rates, but they can lower the mortgage rate. How is that going to translate into people's spending? And why might I think that's more plausible than this opportunity cost story that we teach undergraduates? So the first question you want to ask is, how can homeowners take advantage of these payments? So it's really easy with adjustable rate mortgages. In adjustable rate, remember the interest rate's moving around over time, so it adjusts automatically. So if, let's say, the central bank lowers rates, mortgage rates fall, now I have lower monthly payments for my house, and now I have more money. So that frees up if you have an adjustable rate mortgage, automatically central bank policies of lowering interest rates translate into lower monthly payments. What does that mean for households? They have more money to spend on other stuff, so spending can go up. Now with fixed rate mortgages, it's a little more complicated. The interest rate's fixed, so obviously if the central bank lowers interest rates, their interest rate on their mortgage is still locked in. So here it depends on whether or not they're allowed to get a new mortgage or not, which is called prepayment. And in the US and so many countries, you can prepay or refinance at a cost. What does the refinance mean? It means to get a new mortgage, but you stay in the same home. So how would it work? Well, the central bank would lower interest rates. Then people would say, oh my God, my old mortgage, I was paying 6% interest, and now I can get one at 3% interest. Wow, I should definitely do that. And so they go to the bank and they ask about it and they get a new mortgage. And now they pay much lower money and because they've refinanced. And now what does that mean? That means they get to spend more money. So the long way to think about this, in both cases, The argument I want to make, that I'm making, is the really way that monetary policy works in many countries is through the mortgage market for households. It's not through the opportunity cost story. It's through the fact that when central banks lower rates, the rates on mortgages go down, and because people own homes and they finance them by borrowing, now their payments go down, and so now they can spend more money. And to me, that's a much more plausible story than this opportunity cost story, which relies on people being very forward-looking. So let me provide now a bunch of empirical evidence to try to convince you that this story has some validity. So what we're going to do is, like, these are some standard sort of applied micro techniques. So there's a bunch of papers. I'm going to talk about some of my own, some of other people's. But the best one I want to do is we're going to look at some event studies. And some difference in difference plots. So what does that mean? We're going to compare people. Let's imagine two people, two households. They each got about an identical house at the same period of time. But one person got a mortgage rate that's called a 5-1 arm, which means that it's fixed for the interest rate's fixed for 5 years and then switches to variable. Then it becomes adjustable rate. Whereas another person got a 7-1, which means it's fixed, this interest rate's fixed for 7 years and then adjusts. So the only difference between these two is the mortgage contract. It's how long the interest rate is fixed. So then let's say if interest rates change, the 5-1 is going to have lower payments, whereas the 7-1 will not. So we can compare the difference. So let's see what happens. So up in the bottom hand, let's see what happens to interest rates. So obviously we should see that the one that has the adjustable rate should have lower interest rates. So that's what we see. We see that the person who resets after 7 years in the green, nothing changes. What happens at the 5 years? It drops dramatically. It drops 3 percentage points. And this is real data. So now let's compare the green, the people who couldn't change their interest rates, to the people in the black who could. Well, what do we see? Well, we see that people, when they have lower payments, they're less likely to default. I mean, they're more able to make their payments. We see that here. What do we see over here? They're more likely to cure their mortgages. That means if they were in default, they're now more able to do stuff. They're more able to not be underwater. They're able to pay for afford their mortgage. Moreover, what do we see? We see that their mortgage payments tend to drop. So they were up here and then they drop here. They drop, and for these loans, almost $1,000, which in percentage terms is around 50% of the mortgage payment. So this is a huge drop in interest rates. If you see, interest rates dropped by 50%. So what do we see? These payments, the Fed lowered rates during the Great Recession. As a result, mortgage payments fell a lot. Our mortgage rates fell a lot. And as a result, people reset, they refinance, and interest rates fell. And they paid much less money. They paid much less in their mortgage. So now their house is cheaper. What are they going to do with that extra money? They're going to spend it. So what do we see down here? We see this is what happens on a measure of spending. Do they go buy a new car? What do we see is that after the interest rate falls and they have lower payments, people tend to go buy a new car. Moreover, they also go and pay back some old debt. Like, let's say you had some spending on credit card debt or student loans, they go pay that back. So we see exactly the story that I told you. The central bank cuts rates. That translates through the mortgage market to changes in interest rates. Interest rates fall. What happens? Mortgage payments fall. People have more available money, and then they spend it. That's basically the story that I'm trying to argue. So I think this is a nice paper. You might be interested a little bit about sort of heterogeneity. I think this is a really nice example of a sort of modern macro. I've been very inspired by Yuri Gorynchenko, and one of the hallmarks of this sort of new style of macroeconomics is using clever research designs from applied micro, but with much bigger data sets to answer macro questions. And I think this is a great example of this paper. It suggests that people have a very high MPC, something between, an MPC is a marginal propensity to consume. So if I give you $1, how much do you spend? And moreover, who has the highest MPCs? It's the people who have the highest LTVs. The people who have the most debt, they're the ones who really benefit from having lower payments. And as a result, what do? They go and spend it. So I think this is a very nice paper. So you might ask yourself, though, all of that evidence was about adjustable rate mortgages. What about fixed rate mortgages? Do people actually, because with adjustable rates, you don't have to do anything. My mom could just be not paying attention, rates go down, now she just pays less. It happens automatically. Whereas with a fixed rate mortgage, you have to make an intentional decision. You have to go out and purchase, go to the bank and get a refinance. So I do that in a recent paper with, we make similar graphs with Constantine Milbrand, Fabrice Touré, and Joe Vavra. And so what we're going to do is we just create similar event studies, and we see the exact same thing. So this is what happened. This is an event study. So here we're comparing an individual before over here and after they refinance. And there's two types of refinance. One would be a rate refinance. All they do is change the interest rate. The other is a cash out, meaning they take some money, equity out of their house. And in both cases, we see a big spike in terms of they both go buy cars. So in both cases, it definitely seems like when rates are lower, people are more likely to refinance or spend more money. All right. So now I just want to spend a little bit of time exploring some implications of this that have for monetary policy on some dimensions that you may not have thought about. So the first I want to talk about is demographics. So there's a very nice paper by Arlene Wong at Princeton about this. So what we're going to do is think about, so now that we've sort of had this idea that monetary policy is working to the housing market, we know that different households, different ages have different amounts of homes. So for example, we know that young people are less likely to buy homes, whereas old people are much more likely to own their homes outright. They don't need a mortgage. So if we think that monetary policy is working to the mortgage market, maybe we don't think that old people are going to be responding as much to monetary policy shocks, whereas young people who have a big horizon, who could really benefit from refinancing may. So that's what we're going to look at. So what does she do? I don't want you to get too caught up in the details here, but essentially what we're going to do is we're going to estimate a regression where we say, let's look at consumption by different age groups, young, middle, and old. And then we're going to say what happens when a monetary policy shock happens. So I don't want to get into the details of how she defines it, but she uses some financial market data to identify both positive and negative monetary policy shocks. And then, so here, if you think about the mortgage market, it should happen in one direction. So as interest rates go down, we should expect more spending to go up. And that's exactly what we see. Now, the interesting thing is now let's look across. So this for three groups: young people between 25 and 34 years old, middle, and old. So this is the response of consumption. What do we see? We see that the elasticity, the response of consumption is much bigger for young people than old people. And it's sort of monotonic. And if you break it down into finer age groups, you kind of see the same kind of monotonically decreasing thing. Young people respond much more to monetary policy shocks in percentage terms than old people. Now, of course, there are many more old and middle-aged people than there are young people, at least in the United States. So you can see that by here's the response, and here's their share of consumption. So we see that while young people have the biggest response, they have the lowest share of consumption, or they have a moderately small share of consumption. The middle age have a bigger share. Why? They're a bigger group, they're richer, things like that. But if you multiply the two together, you get the contribution of consumption fluctuations for each group. And what do we see? We see that the young people explain roughly 70% of the fluctuations in consumption. So think about the central bank's objective. What is their goal? Their goal is to moderate business cycles. This is telling you the person who's really responsive to monetary policy are the young people, not the old people. All right. Now, why might that matter? Well, it's well known that many, many, many countries are aging, meaning there's going to be in 20, 40 years, many fewer young people, many more old people. Think about Japan, the United States, China, everywhere. Well, what is this saying? This is saying if you just extrapolated those demographics, that actually monetary policy is going to be 20% less effective. Why? Well, there'll just be many fewer of these young people. And if everything else stayed the same, monetary policy would just be less effective. All right, so why is it? Why might young people respond more? Well, there's lots of arguments. It could be through asset prices. Maybe they have more volatile labor income. Maybe there's some life cycle effect, meaning there's something about being young versus old. Arlene argues it's about housing and refinancing. So let me argue about that. Why would that be? Well, let's look. Remember, we said I was arguing that monetary policy is primarily working to the mortgage market for households. So let's look at home ownership rates by these groups. Well, as is pretty obvious, young people are much less likely to own a home. But moreover, they're also very likely to have a mortgage. And most importantly, they're most likely to have a lot of mortgage left because they haven't started repaying it. And so they have a long duration left. So they've gotten here mostly 30-year loans, and they've only paid 3 years of it. What does that mean? Think about your incentives to refinance. You have to compare the costs and benefits. So let's say interest rates go down. Well, the cost of refinancing is I have to pay some fixed fee, say $1,000. What's the benefit? I get a lower interest rate for a long period of time. So the longer period of time I have, the more benefit I get. So obviously, the longer duration you have left on your mortgage, the more likely you are to refinance. So we would expect that young people would be the people most likely to benefit from refinancing through this channel. So she's going to argue, and I agree with, that this is the main reason why young people are more responsive to monetary policy shocks. Because again, it's just working to the mortgage market. And so she has these nice figures from the data where you can look at, let's decompose that consumption response by people's home ownership status. What do we see? Renters, nothing. If you own a home and you don't adjust, nothing, no change in your spending. But if you go and you refinance, then you adjust your spending a lot. It's exactly what I would have expected. So again, the people who are really driving the consumption response are these people who are homeowners with mortgages who refinance. And it has a nice model to try to match. I'm not going to go into those details, but you can kind of match the data. And it's precisely, as I said, the incentive to do this stuff is much bigger for young people. So I think this is a very nice paper. I think it has really strong implications for the demographics of monetary policy looking forward. And it's just another argument to show you that it really does seem that monetary policy for households is often working to the mortgage market. And since young people are the most likely to have mortgages, they're the ones who are really going to be activated by this channel. So I want to talk about a few other things in my limited time. You may have heard this term. The next one I want to talk about is quantitative easing. You may have heard this term. What is quantitative easing? So basically what quantitative easing is when the interest rates, the central banks can't push nominal interest rates below zero. So typically they're operating at the short end of the yield curve. They're using the shortest maturity interest rate. And then after that goes to zero, that doesn't mean the whole yield curve is zero. So they need to push down other rates. So typically they'll start buying longer duration rates. And that's what they were doing. So in 2008, 2010, in the US, they did this by buying mortgages. So the key though is there's two types of mortgages. I don't want to get into details. They're roughly about how expensive they are, but they only bought what's called conforming mortgages, which are mortgages that are less than $400,000. And they didn't buy jumbo mortgages. So what we can do though, the nice thing about that is we can compare conforming mortgages to jumbo to get a nice comparison. You can think of like, we're going to look at and see what happens to the conforming mortgages. That's going to be like they're treated in a randomized trial. And we're going to use the jumbo mortgages as a comparison group to see if quantitative easing was effective. And what's the goal? They're going to buy mortgages. What's the goal then? That's going to shift down mortgage rates. That's going to make it cheaper to go buy. That's going to stimulate the housing market by making it cheaper to get a mortgage. That was the whole idea. So just to show you, here's a time series plot. In the blue, we have conforming mortgages. Those are the ones the Fed bought in QE1. And we have, in the red line, we have jumbo mortgages. Those are the mortgages they did not buy. So what do we see? And before quantitative easing started, QE1, these two track each other. Then we see that interest rates on conforming, the blue, drop much faster than the red. So that's sort of the causal effect of the quantitative easing. And then afterwards, they kind of follow each other. So we're going to compare the blue and the red. So let's say, so it seems as if by doing quantitative easing, the Fed was able to lower the interest rates on conforming mortgages relative to jumbo. So then what do we see? Well, we would expect that if interest rates were lower, more people would go buy mortgages at the conforming rate. Moreover, we would expect more people with conforming mortgages to refinance. And that's what this is showing you. So this is showing you new mortgages at the conforming rate. So we see that in the pre-period, they look very similar, conforming and non-conforming. And then suddenly when QE starts, lots more mortgages being originated in the conforming, in the blue versus the jumbo. So this tells you that this policy was pretty effective. It was doing what it expected. They bought a certain type of mortgage product. It lowered the mortgage rates on them. As a result, many people went out and bought homes at that level. So that's great. So, and then there's a similar figure for refinancing. Now, a key factor you need, so one thing that I want to stress to y'all is that unfortunately, you know, in the real world, details matter. So oftentimes we have the best of intentions. I'm a sort of a big picture person, so I like to only think about the clouds. But in reality, we have to think about details. So a key feature is in the United States and in many countries, you know, the bank is the one who is allowing you to refinance. You go to the bank and renegotiate the mortgage because that's where you're getting the mortgage from. So in the US, you're only allowed typically to refinance if you have a loan to value ratio less than 0.8. So you have to have at least 20% equity, 20% of the, you have to own at least 20% of the value of the home to refinance. I'm going to refer to this as a loan to value constraint, an LTV constraint. So why is that important? Let's look. So this paper has some beautiful data, so they can look at what did quantitative easing do to the refinancing market. So let's look at people who had enough equity, so they're able to refinance. They had 70 to 80%. And then quantitative easing happens. So now interest rates go down. So now they can get a cheaper loan. So they're going to refinance and they're going to benefit to have more money to spend. So they do that. So we see that beforehand in the red dashed line, it was very flat. You know, it's kind of uniformly distributed between LTVs between 0.7 and 0.8. Then what happens? Then now interest rates go down, everyone refinances, and they all go to 0.8. Why do they go to 0.8? Because that's the max they could choose. They couldn't go any more because you wouldn't, the bank wouldn't let them. So what this means, though, all these people had some equity in their house before quantitative easing, and they took some of it out. The average amount they took out was, say, $4,000. All right, so that means that people did what's called cash out refinances. The central bank lowered rates, people refinanced, and when they did so, they changed their mortgage contract and took some money out of the house. They used that to spend. So that's very cool. But okay, this constraint also is binding. So what about people who didn't have enough equity? We saw a bunch of people had, you know, very little equity in their house a little while ago. So what about those people? So we see it's also, there are many people who say, look at the red line, have 85%. Normally, they would not be able to refinance, right? Unless they could actually put money in. So these people are actually doing what's called a cash-in refinance. So when rates fell, what did these people have to do? They had to come up with 5% of the value of their home to move to the blue line, the blue thing. Why? Because otherwise the bank wouldn't allow them to take advantage of this lower interest rate. So what does this mean? This means that the central bank has to really think hard about the details. Let's say, remember, the goal of the central bank is to stimulate spending. For these households, they are stimulating spending. Why? Because these households, banks are happy to let them refinance. And when they refinance, they took money out of their house. They use that money to spend on other stuff. These people normally over here have too high of loan to value ratios to be allowed to refinance. So to be allowed to refinance, they're actually going to have to give the bank even more money. So this is a cash in refinance. This is actually taking money out of their households, out of the economy, and putting it in the banks. So what does this mean? It means that it's important for central bankers to think about micro details before they do these policies. Because if there were a lot of households like this compared to households like this, then they're actually not stimulating aggregate demand. They're actually lowering aggregate demand. Okay. So this is actually important because this happened in the United States. So it had actually quite a big effect. So you may have heard that, maybe not. So, but you might have heard that there was a very big global recession in 2008, and it was caused by house prices falling a lot. So there are some cities in America where house prices fell over 50%. An example of that would be Las Vegas. There are other cities like Pittsburgh, which they only fell 10%. So we have these two types of cities where one falls very, very far, house prices fall very, very far, and some fall only a little bit. So there's a lot of sort of regional inequity. Now, the central bank only has one policy tool. They can only lower rates. So how is it going to stimulate these two? I mean, kind of intuitively, you would want to stimulate Las Vegas because they're the one that's harder hurt. But that's actually not going to work. Why is that? Well, think about it. If house prices fall, what's happening to your loan to value ratios? Remember, your loan to value ratio is the amount you borrow, that's not changing, divided by the value of your house. That is changing. If house prices fall, the value of your house is going down. So that's in the denominator. That's making your loan to value ratio going up, which means you're not going to be able to refinance when the Fed or the central bank lowers rates. So what does this mean in pictures? Let's look at a bunch of cities in the United States: Philadelphia, Seattle, Chicago, Miami, Las Vegas. And this is before house prices fell. And we're looking at the cumulative, this is a CDF, the cumulative loan to value ratio of homes in those areas. So we know here at this first red line, all of these homes are allowed to refinance. So the key thing is that for most cities, it was around 80% of people would benefit from Fed policy in those, that could benefit from the lower interest rates here. Moreover, the cities look pretty similar. Now let's look in November 2008. First of all, it's dropped a lot because house prices fell everywhere. But the key thing is there are some places like Las Vegas where fewer than 20% of households would be able to refinance. So what does this mean? This means that the Fed is lowering rates, but no one in Las Vegas is able to take advantage of the lower rates because they're, you know, as I said, it's working to their mortgage, but they don't have enough equity in their mortgage to get a bank to allow them to refinance. Whereas Philadelphia, many people are able to refinance, many more than Las Vegas. But it's sort of perverse, right? Because we saw that Las Vegas really got hurt. They're the ones that are killed by this decline in house prices, whereas Philadelphia was not. So paradoxically, through this channel, basically Las Vegas, the place that's hurt the most, is getting the least amount of help. And it's all because of these like mortgage finance rules. And that's what that was showing. So what do we see? So with this paper, what did they do? They kind of, to prove this, they compared, say, let's compare Las Vegas to Philadelphia. So we would call Las Vegas is the black line. I'm sorry, Philadelphia is the black line. Las Vegas is the gray dash. What do we see? They look pretty similar before quantitative easing. And then during quantitative easing, it's all who's refinancing. It's people in Philadelphia and not people. Many fewer people in Las Vegas are refinancing. And what does that mean? That means there's just much less money available to them. And so that means that the places who's getting help, who is the central bank really helping? It's really helping Pennsylvania or Philadelphia. It's not really helping Las Vegas. So the lesson from this is that these micro rules really matter a lot. And to the extent to which it means that we have to think hard about the sort of how mortgage finance is done and what the banks are doing to make sure that the Fed's like monetary policy help is really getting to the right people. And this is one example where it was not. We would like to have been helping our cities that are hurt the most, but actually through our conventional tools, because it's working to the mortgage market, we're not. We're actually helping the cities that are hurt the least. So in my last, like say 5 minutes, I just want to switch and show you one more example of this phenomenon where it's really, you know, important to think hard about the micro details. So let's think a little bit about the incentives of banks. So, you know, banks are the one that they play a crucial role here because, as I was saying, the central bank lowers rates and then the banks are the one extending more credit, either through mortgages or other things. And so the question is when the central bank lowers rates, what are banks' incentives to do that? Do they actually want to give the money out? And do they want to give it out to the consumers that the central bank wants them to lend it to? Because remember, the banks are rational. What are they trying to do? They're trying to make money. So let's think about that. So in Econ 101, the first econ class, that's what they do. The central bank lowers rates, people lend it out. But what about in the real world? So there's this beautiful paper by Agarwal and others that I'm going to talk about now, which uses evidence from every credit card user in the United States to test this. So when the central bank or the Fed lowers rates 1%, how much of that 1% change in the cost of lowering in the cost of finance is translated to borrowers in terms of more borrowing and higher credit limits? So you can sort of think about this in two parts. So let's say the central bank lowers rates. And sorry, my dog just came in. So the central bank lowers interest rates by 1%. There are two sort of things that could happen. One is you have what's called the MPL, the marginal propensity to lend. The bank has to decide out how much of that 1% of cheaper funds do they want to lend out to consumers. And then the other thing is, given that they lend it out, let's say they come to you, all you students, and say you can borrow $100 more. How much of that $100 do you actually want to borrow? So to give you an example, if you allow like a rich person, they may not want to borrow anything. They already have enough money. They have nothing to buy. Whereas if you give a really poor person, they may want to borrow 100% of it. So the effect of a 1% decline in the central bank's borrowing is either it's the product of how much the banks want to lend and how much consumers want to borrow. So this paper has a really nice way of getting at that. So what do? They noticed that for some credit cards, what they do is, so the way credit cards work in the United States is basically based on your credit worthiness, meaning which is summarized what's called a FICO score. A FICO score just tells you how likely you are to repay the loan. A higher FICO score means you're less of a credit risk. You're more likely to pay back the loan. So higher credit score people, higher FICO score, tend to get more loans and more credit. So we kind of see that. That's why it's upward sloping here. Higher FICO score, they're given more credit. Now, normally, it's sort of continuous. The higher the FICO score, the higher the credit you get, and just in a smooth, linear way. But some credit card companies do things that look like this. They kind of look like a stair step. So it's kind of continuous, but then it jumps up suddenly. So this paper uses the jumps. Why do they use the jumps? The jumps are what they're using what's called a regression discontinuity. The idea is they're going to compare people right here to people right on the other side of the jumps. And the idea is those people are very similar. The only difference is they just happen to randomly be on each side of the jump. And the key thing here is you can't really control your FICO score. You don't really know what it is at any moment in time. So we're going to compare these people to these people. And the key difference is they're going to be very similar, but they're just going to have very different amounts of credit, as we can see. These people on this side will have a much lower credit than these people. So this will tell us the causal effect of having more credit. So what do we see is that around these jumps, credit jumps up, but everything else looks pretty similar. So this is kind of a nice experiment that shows the exogenous amount of credits being given to consumers. So now we can look at this both. We're going to now estimate the marginal propensity to lend and the marginal propensity to borrow. So let's first look at the MPB, the marginal propensity to borrow, by different types of credit scores. Up here, we see the average daily balance. That's how much people are actually borrowing. What do we see? Who borrows? The people who have the lowest credit scores, the lowest FICO scores. If you look at people who have high credit scores, they borrow a little bit, but not very much. Whereas the people in the blue who have the lowest credit scores, these are the people who have the worst credit. They're the biggest desire to borrow. They're the ones who really want to take advantage of it. This makes sense, right? If you have a low credit score, you probably filed for bankruptcy in the past, or you're young, you don't have a big history. You're the one who really need the money. So if the bank will offer you the money, you're going to borrow a lot of it. Whereas if you're like an older, richer person, like in the orange, you don't care. So we see is that if we wanted the Fed's policy of lowering interest rates to be translated into actual borrowing and actual spending, we want to be giving it to the low credit-worthy people. That's who we hope the banks are lending to. Now, of course, Do the banks actually want to do that? Well, no, because what is the cost of lending to the lower creditworthy people? Well, the cost is the reason why they're lower creditworthy is they're less likely to pay me back. And that's actually true. So if you look at who's less likely to pay you back, and if you lend to the rich people, the red line, the high creditworthy people, they are very likely to pay you back. That makes sense. If you lend to the people who are not creditworthy, the lowest one, the blue, they're much less likely to pay you back. That's what this is showing you. This is showing the cumulative the chance that you're not going to pay me back in 60 days. So let's put those two together. To stimulate the economy, the central bank would love for us to send this cost of credit out, this money to people who want to borrow. That would be the lowest creditworthy people. So that marginal propensity to borrow is the highest for the lowest creditworthy people. Here on the x-axis, we have the marginal propensity to borrow. We have the FICO score. But banks don't want to lend to those people. Why do banks not want to lend to those people? Because those are the people who don't pay them back. So a rational bank, who do they want to lend to? They want the marginal propensity to lending. They want to lend to the high creditworthy people. But those are precisely the people who don't want to borrow. So when you put it together, what's going on is that actually the banks take the money and they try to lend it out to rich people, but rich people don't want to borrow. So what does this tell you? This tells you that because of the profit motive, actually a lot of central banks' policies are not extended to the people that actually would borrow. So this channel is less effective than you would think so. All right, so let me just sum up. So today the standard story is that monetary policy works through some sort of opportunity cost story. You lower interest rates today, now saving is less attractive because the bank is paying less, so I should spend more money. I argued that channel, does work for some people, but relies on some assumptions of rationality, forward-lookingness, not being credit constrained that are a little bit outdated. And for many households, I think this new story is that it's intermediated through the bank, their balance sheets, through their mortgages. So what do I think is the main lesson to this? The main lesson to this is that we have to think hard to get the monetary policy right about what's going on for households. So it really matters, the details of their mortgage contracts and the details of who banks want to lend to get monetary policy right. And it has big consequences. As we saw, there's some cases where the central bank thinks it's helping the economy, but it's really only helping people who don't need help, or it's only helping the cities that don't need help. And so I think it's important to think about these details. All right, let me stop.
Okay, thank you so much, David. It was a very interesting lecture, and I wish I had such a lecture when I was much younger, when I was studied at Ukrainian University. We've got like 20 questions, so I'm not sure we will be able to answer all of them, of course, because due to time constraints, but we will do our best.
Sure.
So I might skip some questions.
Sure. Let me shut my door. My dog came in the interim. So.
Yeah, sure. Take your time. I will just make a couple of.
I'm here. Sorry, it's the perils of doing this at home. My dog, hears me.
I will make a couple of announcements. You can have a minute of break. So sorry if your question is not answered because we have just too many questions. A couple of reminders. So first, if you attend all lectures, you are going to get a certificate of attendance. 3 best questions will get special prizes. Also, share your feelings, share your experience, share your feedback on Facebook using the hashtag. The 5 best posts will get some prizes as well. And we have 2 more lectures tomorrow and on Wednesday. And then on Thursday and Friday, we have the annual research conference, which is even more presentations, so please join us. Okay, now we will go to questions. The first question was in Ukrainian, and it will be my interpretation of this question. And I will also combine it with another question because they were related. So the first one is by Bogdan, and he asks, like it's my interpretation, basically, he asks about timing of the effect on monetary policy. So, and let me just specify. So you talked a lot about mortgage rates, if central bank changes its policy rate, how quickly it affects the mortgage rate, and then once mortgage rate changes, how quickly households respond. And let me also combine it with question by Irina. What is the average response time of households to changes in central bank interest rate, and comparison of developed countries versus underdeveloped countries?
Okay. Yeah, so these are great questions. Let me speak up. So in terms of the speed at which central bank rates are translated into mortgage rates, that's quite quick, because these are at least in the Western and United States, these are integrated financial markets, so they happen almost instantaneously, maybe over a day or two at the latest. In terms of your ability to take advantage of them, I mean, it takes a bit of a. So typically in normal times, if it's adjustable rate, it'll happen instantaneously. It's because it's just benchmarked to some standard rate. If it's a fixed rate, usually we see lags of 1 to 2 months. So we see many, like it's actually quite quick. There's not the same kind of policy lags you typically think about with monetary policy or with fiscal policy. Now I will say, like right now in the United States, it's actually the rates are quite slow because there's capacity constraints. Like rates fell a lot when we tried to deal with the COVID crisis, and everyone tried to refinance, and the banks are just overwhelmed because people can't be at work and their offices are trying to work remotely. So right now it's kind of totally messed up, but usually it's like a lot more quickly. I think that's an interesting question. I don't know as much about like developed versus less developed financial products. And one thing I was thinking about with Ukraine is, in Ukraine, my understanding is the domestic mortgage market is not as well developed. Like people typically borrow in, is that true that people typically borrow in foreign currencies? You get dollar mortgages? I'm not quite sure.
Yeah, I think so. I think it's true.
Right. So in that sense, you're exposed to some foreign exchange risk, but you would still be taking advantage of like a more developed mortgage market. I suspect that this channel is less effective in less developed markets because there's going to be higher risk premia, but this is just pure speculation on my case. I think it'd be an interesting thing to think about. I know much less about, there's much less empirical work about that question, which I think would be useful.
Okay, great. Thank you so much. Next question, and where it is, sorry. So next question is by Pavlo, but I cannot see. Okay, so it's here now. So Pavlo asks, which type of monetary policy, contractionary or expansionary, would be more suitable for Ukraine? And let me specify this question. So Ukraine now, in a case, so we are trying to target inflation, and we used to be not very successful a couple of years ago, but we started to be successful right before the COVID crisis. And now we have, on the one hand, our inflation can be about target next year, but on the other hand, we have this COVID crisis. In your opinion, how monetary policy, like how effectiveness of monetary policy could be different in this COVID crisis compared to previous crisis, or it's basically the same, no difference, I don't know, given it's a very specific crisis,
I mean, I think that's a great question. So I'm not an expert on this situation, so I don't want to speculate on the relative weights one should put on inflation targeting versus not. I mean, I had thoughts about that in general. I mean, if I was purely speculating, I personally think that central banks put often too much weight on inflation relative to, output and employment fluctuations, given that the cost of job loss is quite enormous. Sorry, my dog is, I don't know what's barking at. 1 second. Oh, wait, shut up. No. Okay. Sorry, my dog is crazy. Let's see. As for the, all right, you got it. You take him. Away. Oh, come on. Yeah, thanks.
Yeah, dog. Also.
The COVID crisis affects us everywhere. Yeah, that dog does not like Zoom. Too many pictures. Okay, so yes, the question was about like monetary policy and COVID. I mean, it's a complicated question because, you know, right now we don't want people to go out and spend. We want them to spend money. We don't want them to go out of their houses, right? So It's like all the channels are a little bit more complicated. So yeah, I'm sorry, I don't have anything like super novel to say about that.
Okay, thank you. Next question is by Olena Sergeyeva. She asks, could be a thing that young, when they become older, will respond with same rate? Could it, young, respond more, be the effect of modernization or education? So my impression that Olena is asking about your decomposition of different age group responsiveness. And in this respect, I might a bit extend this question. So could there be other reasons young and old respond differently rather than just mortgage? Maybe, you know, some habits, education, some other things. Maybe young agents in the future will be more likely, you know, to rent apartments and not to buy houses, and this also might affect things.
Totally agree. Yeah. So I mean, the statement in that paper that I was making is a sort of all things equal, ceteris paribus statement. You know, like assuming that the structure of the mortgage rate and people's trends stay the same. Obviously, when you're speculating over the next 40 years, that is wildly crazy. I do, and moreover, she made a subtle point, which I think is quite good, is important, is that I'm assuming that kind of the latent responsiveness to these mortgage products is the same over time. Now, maybe that's a reasonable assumption in the United States, but like obviously, you know, in other countries, I mean, it may not be a reasonable assumption. And I think it's true. I mean, you know, I kind of started working on this because I talked to my mother. My mother, you know, it's not someone, you know, my mom has a PhD. She's a very smart woman, but she doesn't refinance all the time in an optimal way. You know, we have these models about when you should do this at all about costs and benefits. And for her, it's like, for me, it's exciting. I love talking about mortgages, but it turns out normal people don't want to talk about mortgages. Okay. So maybe it is true. And it's actually a prescient point. So one thing that's happened is there's been a lot more online finance in the Western world. So I bet in Ukraine as well. So it's actually much easier to do it just on your cell phone. And I imagine young people are way more likely to do those things. So in some sense, there's ways you can think about it in either directions that it could go. Young people could be more likely to rent, and so this channel will diminish. On the other hand, you know, young people are much more willing to adapt to new things as we move to more online refinancing, and so they're more likely to be, you know, able to do so. So good question.
Oh, okay, thank you. Next question is by Andriy Buz. Does this mean that developing countries will gain a comparative advantage due to the increase in the aging population in developed countries and the corresponding decrease in the effectiveness of monetary policy? So I think it should be vice versa, basically, that if young people respond more, then countries gain some comparative advantage in effectiveness of monetary policy. What do you think?
I think that's right. Yeah. So I mean, it's a big channel. I mean, you know, there's lots of headwinds for developed countries. This is just another one in terms of their ability to regulate their economy. To the extent to which you have more young people in your economy, if you believe this channel, that means you're going to have more people who are more responsive. You know, I mean, it's just like the fact, you know, this concern in the rates have been falling, and so the Fed has, or central banks have less sort of policy room. This is just another argument for why developing countries are going to have less ability to stimulate their economies. So that's right.
Okay, good. And how do you evaluate how much is this effect? So if you decompose the total, you know, change in consumption, the change due to mortgage rates, how much is it?
Yeah, that's a great question. I don't know. There's no credible evidence of that. I tried. I mean, so what I will tell you is that I have looked, like I've done some sort of aggregate vector autoregressions, like smooth transition bars to try to look at it. And, you know, it does seem to show up in the aggregates, but it's very difficult to decompose how much, you know, there's many channels through which monetary policy could work, you know, on the firm side. So I don't know. I think this is a substantial one. But that's a great question. That's like still open research. We don't know, you know?
Okay.
Yeah.
Okay, maybe 2 or 3 more questions. Alina asks Alina asks the following. You talked about fixed rates and the adjusted rates, but what about, I'm not sure what it means, PLAM and dual rate mortgages?
I don't know what that is. What is a dual rate? Yeah.
Okay, so maybe
I would
Alina
love to learn about it. I don't know. Yeah.
can email you after and then
Please do. Anytime. Any of you can email me. It'd be great.
So then maybe the last question, because it's already like 1 hour. So I had a good question, but yeah. So Andrei asks about a professor from Harvard University, Jeremy Stein. He said that during crisis, the central bank should be not the lender of last resort, but venture capital of last resort. So what do you think about this statement?
So again, you know, I'm purely speculating. So speaking from the United States example, you know, going through this COVID crisis, we're in a situation where functionally we want people to stay home for public safety reasons, which is absolutely the right thing to do. On the other hand, you know, we have these programs that are able to lend to companies, but they don't have revenue. And I think we should, you know, on the other hand, rates are historically low. And, you know, you have to ask yourselves, what are the costs and benefits of dealing with massive bankruptcies? You know, I think that, you know, the economies are not meant to stop for 2 months, 6 months, a year at a time, right? And so if you think about Jeremy Stein, he's saying the Fed can essentially print unlimited money. You know, obviously there is some limit. There's some debate about that, but like they can print a lot of money and borrow at very low rates, you know, and you have to evaluate that versus the cost of having widespread business failures. So to the extent to which the Fed should be doing that and taking equity stakes and or you know, extending loans to these companies with some equity stakes, I don't think that's the worst idea in the world. You know, honestly, I think in the US, you know, we have kind of not great infrastructure. We should be borrowing right now. There's many people who we could borrow a lot of money and rebuild America. We could build trains connecting our cities. We could be rebuilding our bridges and things like that. And there seems to be no will to do that, unfortunately. But I do think that's something the central bank should think about. I will say, having you know, knowing people who work at central banks, you know, that's obviously something that they feel very reluctant about doing. First of all, it's not like their main capability, but it's also then it's, you know, it's a little bit, they're reluctant to take on more responsibility when they're not necessarily all elected officials and things like that. I mean, and sometimes you want the Federal Reserve to be administering all of these, you know, in the US, I think the Federal Reserve is maybe the most competent government agency, in just my opinion. And so maybe it would be great. There's just like questions about how much, you know, capacity and do you want to give to that kind of agency, you know? But I'm actually mostly in favor of what Jeremy Stein was saying. That's a good question.
Okay, so I think we can stop here. We do have much more questions, and I'm sorry to those of you who wrote a question, and then some of them were good, but we do not have time to answer all of them. But I asked David now to choose 3 best questions. If you remember, I can remind you, like we had first 2 questions. The first was about like timing of monetary policy. Second was about, you know, developed versus developing countries, whether there is some difference in timing. Then the question was about contractionary or expansionary monetary policy. Fourth question was about whether, you know, whether elder generation, younger generation behave differently due to some other reasons. Then was a question I already forget about. And the last question was about Jeremy Stein. And the last but
so for me, I think the best questions were about the timing, the propensity of older versus young to change over time. I thought that's a very important question. That's hard to answer. And then I think the developed versus less developed countries and how this kind of channel can vary. Because I think that's an area of like research that we don't know, but I think would be very interesting.
Okay, great. So I
I thought all the questions were great, and thank you for putting up with my lecture. I appreciate it, all you students. So.
Yes, thank you so much, David. Thank you, everyone who joined this lecture. We are going to finish soon. And I just remind you one more time that we have 2 more very interesting lectures on Tuesday and on Wednesday. And then we have 2 days of the conference on Thursday and Friday. So that's it. All the best. Enjoy your day.
Yep. Thank
bye
you.
bye.
Bye bye.